We go back a long time. Prasenjit, me, Manish, we all joined in class 4, 1986. I think we were in Premanandha together, all of us. And ever since, we've known Manish from near and far, and he has gone on to achieve big and great things. So he'll talk about all those things himself. But just a brief insight into him from very young age. He's always very bright. Studies maybe, and he's an excellent artist. Tabla bajane mein bhi master tha. And we worked on a number of things together. When we left Vidyapeeth, we sort of charted our own course in different ways. He studied in Delhi, wahan se fir he went to US, and then he has made his own mark. I'd like Indranil and Prasenjit to join me in saying a few things before we hand the platform to Manish. So Indro, Prasenjit, please feel free to contribute.
I would like to add whatever you have already said, Abhishek, about Manish. Known him since class 4 when we joined together. And although he was a localite, most of the time I used to forget that he's a localite because he used to be so with us and be the same like us. Because unlike a couple of other people who were locals, they would go home or they would be visited frequently. So Manish, and he used to be someone who always being intelligent, but at the same time he was a bit, shall I say, chilled out. Yeah, he was he appeared pretty laid back to me always. And later on, when he was in the financial markets, and well, still is, my impression of someone who would be in that sort of a field was very different to what Manish has appeared to me over the past few years when I've even met him in America. And, so I think everyone else will agree that Manish, despite his high profile and highly charged lifestyle and work, he tends to enjoy the finer things in life and has a very good work-life balance. A lot of things that even today I feel that some of us can learn bits from him. Manish, I hope you are thoda zyada nahi bol diya na?
Prasenjit?
Yeah, I would like to add, something about Manish. So I remember, when we were in 9th or 10th grade. So whenever Abhijit, our math teacher, would ask, like to solve any challenging problem, he would be the first one to raise the hand. I mean, he was not right all the time, but he was the first one to raise the hand that yes, done. So he liked challenges. So, and I think that shows and still shows on what he's doing, taking new challenges every day.
Of course. Well said, guys. And even as Indranil highlighted, that despite having a very successful and high-flying career, he's remained modest, humble. We recently met in that reunion in the centenary celebration, and we had a lovely time. And I think this comes from how his parents were. I still remember them, uncle and auntie, so humble and kind, and they were always very lovely and loving. And it goes right back to the roots. He's got a wonderful family, wife and 2 children, and the way he's looked after them, parented them, we have a number of conversations time to time. And he's extremely well read, and he's exploring all the various interests, not just in the mad world of the Wall Street finance, but he's kept that balance. And we wish him all the very best. So over to Manish.
Thank you, guys. I have never heard so many things about myself in a long time. Thank you. Acha laga sun ke. In terms of the financial market, I want to steer the conversation slightly differently. So I will start with slightly higher level by saying the how this entire world is organized. So when we say about financial market or Wall Street um, work, or just work related to the stock market, there are so many things, so many different type of segments, that often it is very hard to figure out who's doing what and how is it organized. So I want to explain it slightly differently. In the world of finance, there are two organizations. One is called the bank. Another, rest of the entity, let's say, is non-bank. What does a bank do? Bank is a source of liquidity. Liquid meaning money. If you need to do anything, you will go to the bank to get the money and you will do it. So bank is a source of liquidity, hence bank is a source of the transaction. And that's why the banks are called sell side. So banks are the sell side, meaning they are selling liquidity to people, and the rest of the organization are then divided accordingly. A bank typically does, when you hear from people about investment banking, the investment banking typically is the kind of activity that a bank will do by providing its resources and liquid to initiate or have a transaction within the corporate world. So there could be merger acquisition, or a company trying to buy another firm, or a company going for a massive spend. So when a company goes for massive spend, that is called as a commercial banking, meaning the bank will give simply a loan. When it is a merger acquisition or buying of a company or stock buyback, these are called the corporate actions. And that's when a bank provides loan, its expertise, etc. So these activities of a bank that helps a corporate action is called investment banking. And all the big names you hear, Goldman Sachs, JP Morgan, Morgan Stanley, they are primarily investment bankers. And then typically the people who work in the investment bankers, they want more such transaction to happen, and they will get the commission out of it. So this world is also called as a capital market. Why? Because banks have the capital, and there's a market about it, and that's how the transactions will happen, and that's how everyone will make money. The other side of the world, which is the non-bank side of the world, which we call, in our lingo, is called the buy side. So what does a buy side do typically? A buy side will buy the money from the bank and will initiate in some activity. And among the buy side, there are several types of organization. You will always hear this term called asset management. Asset management is a wide umbrella that talks about how an asset will be managed by a company, an asset that may belong to the company itself, or an asset that may belong to any other individual. Within the asset management world, then there are many worlds. And now I will introduce the world where I belong to. So in 1960s, here started a movement that said that if I keep my money in the bank, or if I keep my money invested in an asset, my money keeps growing, or even if I buy this stock, my money goes up but it is not managed well. When the market goes heavily down, I lose a lot of money. So someone needs to take care of my money in a way that as the market goes up and down and up and down, the effect of the market volatility or the effect of the change in the market condition should get less and less on my money. Meaning, my money should grow regardless of what's happening in the world, which is what everyone wants. And that's how in the 60s came the term called as hedge fund. The word hedge typically means that the risks are hedged. So the idea that your investment will be invested in a asset class, maybe let's say stock, and then that risk will be hedged by buying some other asset, which may go up if the stock goes down. So that's called managing the risk and hedging your future risk so that the return on the portfolio will not get affected by the changing condition. So this was the idea of the hedge fund. And the idea was that I will continue to increase the money of my client irrespective of the economic situation or market condition or how I have invested the money. Hence, I may not give you huge returns, but I will protect your wealth. So meaning it is better than keeping your money in the bank. It is absolutely better than buying a real estate. So I will give you more returns. And then came the word called market neutral, which is my returns will be neutral to the market. Why? Because market may go up or down, but I will continuously provide you return. So that was the idea of the hedge fund. But then in 90s, this idea got completely obliterated. So the whole notion that I will provide my clients a market neutral return, that motive remained, but the competition intensified and the hedge funds started taking risk, enormous amount of risk. So then the competition was, how much return are you giving me? 20%, 30%, 40%. And as the competition heated up, funds started taking risks. And that's when we call a new type of funds came into light, which is called the systematic funds. And that's what I do for a living. What systematic funds do typically is, instead of someone researching a company and thinking about, should I buy in this company or not, which is called the discretionary, where the discretionary investment, meaning the investment is decided by one individual or by a group of individuals after they have read about reports, formulated their opinions, and have had conversation with many people. So it's a well-formed opinion about a company by human beings. That's called the discretionary investment, because it is at the discretion of some individual or a group of individuals. Whereas the systematic investment is not it does not depend on human idea or human notion. They depend on algorithms. So what we do is we have algorithms that run across all asset classes of the world, and they figure out at what time this algorithm should be bought and at what time a particular asset class can be sold, thereby trying to optimize the return. So higher return and lower variability, meaning lower vol. If I decrease the vol or the variability of my earning, while I continue to increase my earning, then I get the same effect, which is called the market neutral, but I can generate massive amount of return for my clients. And this happens systematically. And in this systematic world, there are many types of companies. You will hear this term often, that a hedge fund is high frequency firm, or a high frequency, medium frequency, low frequency, etc. High frequency firms are firms who have capability to react at a micro millisecond. So meaning when before the information comes to the normal people, they would have already bought and sold a stock. So those are high frequency firms. Then there are medium frequency firms, etc. So in the world of systematic investment, or some people also call us quantitative investment, or quant investors, but they are more or less the same, which is systematic investment. And our entire theory is based on a lie. This I never say in front of the client, but since it is Vidyapit, I'm saying. Our foundational theory is based on a lie, which is what happened in the past may happen again. But what happened in the past does not happen again. Very rarely it happens. But we all believe that it may happen. So we use these models, we use these machine learning models and AI models to look at the historical information and the data. These historical information and data is typically learned by the models. And then based on where the market is right now, the algorithm tries to forecast where the market will be. It is often, it's not a perfect science. It is a mix of science and art. You will get it right a lot many times, and you will get it wrong a lot many times. And this is where the expertise of someone like me comes into picture, is that once I have the output of the model, how do I use it? And this is where the secret sauce lies. Essentially, this is how firms try to differentiate from each other, or good firms have a model that has higher accuracy, and a bad firm has a model that has less accuracy. Nonetheless, the effect of how you utilize these signals, or sort of call the information that you get from the model or the forecast, now how do you use it? That's where the secret sauce is, which is, if my model says that a stock, let's say Apple, is going to go up by 5%, and at the same time, the model also says that, let's say the stock of the, let's say if Apple goes up and it says that the stock of the NVIDIA will go down, for example, then I will be a muppet to simply go long on Apple and go short on NVIDIA, because the hit rate of my model could be 51%. So what if my model is wrong on both? And I will make money only if my model is right on both. So if I simply agree to what the model says, I'm going to lose a lot of money. So then comes the world of multi strategies based on the signal that you get, and which is a function of where the market conditions are right now, which is, even if the price of the, let's say, model says that the price of the Apple will go up, and the price of the Apple is slightly going up, what do? Should I orchestrate my trade in a way that I buy lots of Apple stocks? Yes, I can, but I will also wait, but I will also know what is the range of the movement of the Apple stock. And similarly, I know the range of the movement of the NVIDIA stock, which as per my model forecast is going to go down. Now, based on these range, which we call in our language vol, or the propensity of the stock to go from up to the down, so what is the range to which it will go up and down, is how I will orchestrate my trades in it. Similarly, if a stock is going to go down, what is the propensity of that stock to come back from its lowest point? So the nuances, so meaning the effect of nuances on a stock, given the forecast you get from your machine learning model, is what makes or breaks your firm, basically. And people who look at these nuances and look at these minute things, minor nuances, and manage money and manage risk are called portfolio managers. So basically, the role of a portfolio manager is to take all the information, the signals that people say, which is "gaon walon ne aisa bola hai," and take all that information and then make that decision as to how to deploy the money that I get, that I have right now, based the inputs I am getting from the models. So the people who make these models are called researchers in our world. They are called as quantitative researchers, whereas in the discretionary firm, where people just read lots of reports, they read a lot of interviews, and they read lots and lots of other information, those are called as analysts. So analyst, researcher are basically same type of people who will provide signal to their portfolio manager, and the portfolio manager then makes the decision that based on the signal and information I have, I will go and I'm going to do this, and I'm going to deploy this amount of money, or I'm not going to deploy this amount of money. And then based on that decision, sometimes we get right, sometimes we get wrong, but hopefully we get more right than wrong. And that's how we make money. Now, the last part I want to explain is how do we then make money? It seems like it is quite a hoodoo science. I mean, you just make some decision on your own, and then you buy some stock, you sell some stock. But yeah, that makes sense as to how your investor will make money, but how do you make money? So there are different setups of the firms. The most common or most prevalent way in US or in and around New York is called the 2 and a 20. 2 and a 20, meaning I will take the 2% of the asset under management that I'm managing from the client to take care of my administrative work, right? So meaning salary, SG&A, etc. So if I'm managing, let's say $100, out of that, $2 of the client directly goes to me, and it does not get invested. So the $98 gets invested. Then out of the $98 that gets invested, whatever is the profit, let's say I made a profit of $40 out of the $98. From that $40, 80% typically, that is the industry rate, goes back to the client, and the 20% of the profit comes back to the firm, and then the firm will figure out how to distribute that money in terms of salary or bonuses, etc. The other type of, so this is typically how the hedge funds are in terms of the economics. It's a very basic economics, and if you read it well based on the incentive I gave you, there is no punishment to when we go wrong. So let's say the return was negative 15, there's no punishment to me, but yes, that return will get accumulated. The negative 15 is part of the return that I will file at the end of the year, and hence I'll make less, because instead of negative 15, I could have made a positive 15, and then that money could have come to me. So because there is incentive to do good, it is assumed that there is no incentive to do bad, which is quite valid assumption. And if there is incentive to do good, and if that good is a percentage of what I will make, there is incentive to continue to doing good for the client. So this is the underlying hypothesis of the entire industry. Now, when you buy what's called mutual funds, you pretty much do the same thing. But when you're buying from a mutual fund, you are giving someone money. You are giving some money to that fund who takes care of your money and gives you back some money. The problem with the mutual fund is that you don't know on a day-to-day basis what they're buying or what they're selling. You are simply getting some unit out of it. Whereas in the hedge fund, which is a sort of a world where everything is extremely transparent to the client, and client knows exactly what we are doing, how we are doing, what is our philosophy, and how do we invest. And definitely the returns are way higher because we are more quantitative firm. So we need less people to manage the firm. And the returns in terms of the number of resources required to generate an additional 15% return or additional 20% return is far less than in the discretionary firm, or even compared to the mutual funds completely. So that's why more and more people come to us, more and more investors come to us, and they're interested generally. So now I'm explaining you the next part of my role, which is how do I entice people to invest on us. So people generally, it generally starts with a curiosity, meaning how do you do it? And once we are able to explain them how do we do it without revealing our secret sauce, they get hooked on not with the pursuit of making money. Trust me, most people I have met in the US who are very wealthy or the institutional investors, they're not interested. The prime objective is not to make money, but the prime objective is to be part of this pursuit, of this fancy pursuit, to uncover the market. And this is like a joint pursuit to unpeel the onions, so to speak, and to understand why the market moved and how the market moved. And that pursuit or that experiment is expensive. It requires you to put some money. And that is how the discussion always begins. And once it gets it right, once they are satisfied with the experiment, then the money starts to flow. And the last part is you will hear that the hedge funds are not always successful. They are not supposed to be always successful. Why? Because as I explained to you in the very beginning, the underlying hypothesis is on a lie, which is what happened in the past will happen again. And that's not true. So when hedge funds get quite too big for themselves, when their head gets bigger, they make stupid mistakes. And once they make these mistakes, a day comes when the fund will be over. So typically what now is happening, you will see these large hedge funds like Millennium or Citadels. These are large hedge funds. They have diversified from the art of putting money in the market to the art of making the market. Making the market means because they are large fund, they have positions in most of the stocks. So if a buy-side firm wants to buy, let's say, Apple stock, then someone must be willing to sell the Apple stock. Only then the transaction will happen. And the guy who enables that transaction to happen, they are called market makers. It's an extremely profitable business, and that's where the larger funds are now moving in becoming market makers, because they already hold positions in many stocks, and that helps them generate liquid at a very regular basis. So from a sell side, from taking money from the bank to do the transaction, to the buy side, from buying stocks, bonds, etc. for your client, to market making is what I have seen happening, and perhaps will continue to happen. So with that, I end my discussion. I would welcome if people ask questions. Please make them happen.
Dada, this is Vikas. I want to know that you told us that we generally invest in most of the asset classes. So, do we include real estate, mining, crypto, digital assets?
So yes, I mean, anything that can be invested, anything that is liquid, meaning if I buy, can I sell it when I want to sell it? That's called liquid. Then it can be invested. So you said about real estate. The way real estate investment happens in our world is via a investment category called REITs. So these are real these are like indexes that are based on the real estate properties, and you can buy and sell REITs pretty much like you are buying and sell uh, Apple stock on the exchange. So that's what most people do. But a company that buys and sells real estate only, meaning hard brick and mortar real estate, those are called as real estate investment companies.
Okay, Dada.
And yeah, you asked me about the crypto. So crypto is a completely different asset class. Why? Because it does not trade on the exchange we are familiar with, right? So the Nasdaq or the S&P or the Russell, these exchanges or these indexes do not have the crypto. They are not on our exchanges. Cryptos are on a completely different exchange, and that exchange runs 24/7. It never stops. And because that exchange never stops, it has a completely different dynamics and a different correlation factor with the market microstructure, which is the state of the economy we are in right now, or the state of economy we will be tomorrow. So that anticipation is very, very hard on the crypto, and the underlying asset valuation of the crypto is very hard because we don't know what the underlying asset is. The underlying the perceived asset of a crypto is simply the perceived demand and supply. That's about it. So it's a completely different world, and hence a different exchange, but nevertheless extremely profitable if you can get it right.
Dada, doesn't like Bitcoin also depends upon the utility, like how much uh, we can use those that crypto technology and various other things, not just about demand and
Yes.
supply.
Yes. So once the crypto currency, once they become more pervasive, and if they are, so let's say a credit card company, and this is I'm not saying imagination, it may happen anytime soon, is that if a credit card companies starts to give you the option to do a transaction based on the cryptocurrency also, if that starts to happen, then we will see wild swings in the crypto market, meaning now you are using the cryptocurrency to actively buy and sell goods. That will change the landscape completely. Even now, you can potentially do a transaction with the crypto, but in very limited sort of a space. You can buy a few things. But once it enters the mainstream, meaning if a credit card gives you that option, that you can choose rewards, or you can choose your normal credit card, or you can choose the cryptocurrency. If that happens, that's it. It will change the world.
Okay, Dada. Thank you, Dada.
Manish, tell me, ek baar bata, if
Ah.
you hadn't been what you're doing now, what would you have done? An alternative career.
Well,
You secretly wish.
I wanted to be a doctor, which I failed. I failed the exam, the entrance test. That's what I always wanted to be, but wo nahi hua, fir ye hua. If I wasn't this, probably I would be a professor somewhere who would have had to do a PhD, but yeah, maybe.
And one secret wish in life.
One secret wish in life is that
Mind you, this is a public platform and it is being recorded.
is that I get, I mean, it's not that exactly secret, but I do want at least 2-3 months away from everything, if I can execute that.
Okay.
Yeah. That's the only wish I have.
Indra, Prashanjit, do you want to ask him anything?
Well, I'm sure, Manish, to fulfill your wish, you can take a temporary posting in Vidyapit, Monks Quarter.
Hey, Manish, I had a question. This
Yeah.
is Arijit.
Yeah.
Hey, so I don't know if I joined in late. Sorry, man. I did miss most of it, but I just wanted to have your like feedback or your um, thoughts. Like, did you talk about the GameStop saga?
What? Talk about what?
What happened with the GameStop, like with the hedge funds and stuff?
Good. Good point, Arjit. So what happens with the meme stock or the so meme
Yeah,
stocks are
meme stock.
yeah,
That's what we're talking. This is like a new thing, and all the
yes,
millennials and everybody talks about it all the time. So I just
yes,
wanted to
yes.
have a feedback from you.
Yeah, so the name meme stock was given to these stocks because these stocks would move quite esoteric in nature. Esoteric because uh, there was no rhyme and reason for these stocks to go up. So historically, what happened was GameStop. GameStop is a company that
Mhm.
has it's like a brick and mortar company where
Correct.
people would go to play game. So there are video game and consoles, and people would go rent the game and play the game. That is what was the business of GameStop. Because as the technology moved, as the technology changed, there was no need for a company like a GameStop. Hence, the stock price of the GameStop kept going down. Then there were some group of people who were extremely unhappy why the GameStop was going down, and they blamed the Wall Street for its demise because Wall Street was shorting the GameStop big time because there was no need for that company to happen, and the company's financials were also quite bad. What these people did was phenomenal. They started buying GameStops, and because they started buying the GameStops, the interest rate required to pay to short the GameStop kept going up. As the rate went up, the expense to short the GameStop kept going up. And this signal was suddenly seen by many other quantitative shops, is that we call it short interest, meaning the expense of the short on the GameStop is now going up. So they're like, something is happening. Someone must be buying the stocks. and someone is buying stock because he may have some other information. And that led to some firms change their direction and they went on to buy the stocks. Now, when the short interest is also high and someone is actively buying the stock, it typically means that the people who are holding the short will have to sell their stocks very soon because the stock is now going to go up long. And that's called margin call is going to happen, or a cover call is going to happen. They also call as short squeeze, meaning I'm holding the stock and the price kept going up, so I'm going to have to now sell my stock by buying the stock somewhere because I was shorting the stock. So let me explain how we short a stock. We short a stock not without having the stock with us. This is the most funny part of the US and European market, is that you may not have the stock with you. So meaning you don't have Apple stock with you, nothing doing, but you can still short it, meaning you can short sell the stock, and meaning you can say and you can declare that you are going to sell the stock at, let's say if the price is 100, you can say I'm going to sell the Apple stock at 50, which means you are short selling the stock and you don't even have the stock. So, but if someone comes to you and says, oh, nice, I'm willing to buy the stock at 50, you are hoping that by your declaration, the stock would have gone down enough for you to make a money on that transaction. So this is the business of the shorting the stock. So as the short interest goes up, meaning the expense that the bank will want on a shorter stock, as it keeps rising, it signals the market that the stock is actually not going down any longer. It may go up. And then it becomes a frenzy. So everyone then starts to buy. So one fear leads to another fear. So what started as a movement by few people who were unhappy with the Wall Street quickly caught on like a jungle fire, and the GameStop went up massively. When GameStop went up, those individuals now got to a bigger group of people and bigger group of people and bigger group of people. And they made a lot of money by simply buying GameStop. And the same technique was repeated on other stocks as well, like AMC, where a group of people got together, pumped and dumped the stocks. It happens, and it should happen, because at the end of the day, it democratizes the way we do business. It's not about some expert saying their stock will go up or down. Who are you to say that? It is ultimately the exchange is about democratizing the opinion of the people about a company. And I think it's a healthy thing. It should happen more and more.
Very interesting, Manish. Do you think it's kind of a way that they played the market or something?
No,
No, okay.
no,
Okay.
they did not play the market. It was David versus Goliath,
Goliath, yeah.
and with the same ending.
Very interesting, very interesting. Thanks, Manish.
So
Hey,
Manish,
Manish,
in
Prasenjit. Okay.
Acha,
Yeah,
Prasenjit,
someone, go ahead.
carry on. You carry on.
Okay, Manish. Yeah, tell me one thing. So, in order for a transaction to happen, so there should be a buyer and a seller, right?
Yeah.
Has it ever happened that someone is not able to sell a stock or buy a stock because there is not a seller or buyer at the other end? Has it ever happened?
Yes,
Or
it
can
happens.
it possibly happen?
Yes, it can happen. Theoretically, it can happen, but practically, it does not happen. And the reason is, so all these transactions that you as a retail individual and we as a firm, we do it via a entity called as a broker, right? The broker dealer. It is the promise of the broker dealer to make that transaction happen, no matter what. So if no one is willing, so let's say you want to buy a stock and you send a request to the broker, and no one is willing to sell the stock, but that buy order must be honored. At what price, that you don't control. That broker will also control in some situation, and in most condition, it is based on the market condition. But the broker will honor that transaction. And even if no one is willing to sell, broker will on his book say that this transaction happened. And then at some point in time in later, when a seller appears, then he will sell that stock.
So if it is a
Yeah.
so if the transaction like had a loss, so the broker is going to take the loss?
Yes.
Okay.
Yeah. Broker business is not about loss. I mean zero risk. There is this risk, what we call as risk of latency. So let's say I want to buy a stock for which there is not enough liquid, meaning for it there is not enough participants, right? But the broker will have to honor my transaction. And then
Got it. Thank you, Manish.
Yeah, and then there will be a late. Maybe there will be 1 second delay or a 5 second delay in finding who is willing to buy, willing to buy or sell. In that 5 second, anything can happen.
Yes. Got it. Thank you.
Manish, ये बताओ, in the light of the recent election results in India, how do you think the market and the economy will play out? The agenda, will it become more populist, or will they continue with the growth of the infrastructure investments and some of the high-tech investments they have been doing, or with the allies in this coalition politics, do you think it will become more populist?
So there will be two type of people in India and abroad. People who have not read history and people who have read history. People who have not read history or are not familiar with how India operates will now believe that the speed of the reform will be very less, and this and that, more populist measure will be taken. This is your mainstream Western media who have no clue about anything. They don't even know who their father or mom is. Then the other set of people who have read history. So far in the history of the Indian democracy, the boldest reform was taken by Prime Minister Narasimha Rao, and he had 242 seats. Same number of seats that Narendra Modi has. And no one knew Narasimha Rao, and everyone knows Modi. So the popularity of that one man is way higher than Narasimha Rao. At that time, India was in absolutely doldrums when Narasimha Rao became the prime minister, and right now India is not in the doldrums. So from historical perspective, if you compare the two events, which are very similar in terms of the election outcomes and quite dissimilar in terms of the macroeconomic conditions of the world, there is no reason for India to step back or pull back on the reforms. India is the only country apart from the US, that is liquid, where there is enough liquid for transaction to happen and where there is political stability and there is a reasonable transparency of the market. There is no country right now the size of India, which is an alternative to US to invest. And as the next government in the US will come, the interest rate will have to go down because interest rate has been way too up. As the interest rate goes down, the incentive to keep money in the US dollar will start to decrease because the bank is giving you less interest, which will mean that people who have money will have to find new avenues to invest. And what other better avenue than India? So you will see that FDI will skyrocket in the coming year once the new government in the US has taken its form and shape. And if there are no war or nothing of that happens, I think the Indian economy will continue to rise unabated.
Does that depend on who becomes the US president?
Yes. It has a factor to it because the interest rate decision, as far as we understand, is a factor of who is the president. Even though the Fed is supposed to be autonomous, but so we all know that interest rate is going to decrease, but when is an important question. And that when will be sooner if one government comes versus the other.
Okay. Sugato, you are very quiet. I can see you in the audience.
Manish, this is Ritesh here.
Hey, Ritesh.
Hi, Ritesh.
Yeah, one question, kind of a philosophical question here for you, but generally the firms make money by creating value. And what I mean by that is, for example, a pharma company is making drugs to save lives. Even Hindustan Liver is kind of making toothpaste so that you can brush your teeth, let's say, right? What's the value these financial companies are creating in order to make all these money? Do we need them? Do we need all these financial companies? Do we need all these financial instruments? And what the value is being created?
Good question. Very good question. So let's see. Let's hypothetically decide that there is no such financial companies, right? So Hindustan Liver continues to make toothpaste, and if the toothpaste is good, more people will buy the toothpaste. If the toothpaste is bad, less people will buy the toothpaste, right? And that is the incentive for Hindustan Liver to produce more toothpaste or better toothpaste. At the end of the day, someone needs to evaluate on a pretty regular basis whether Hindustan Liver making the toothpaste is doing a better job at making a toothpaste, or Reliance, who is making a toothpaste, is doing a better job at making a toothpaste. Who among the two is doing a better job? Meaning, which among these companies are more efficient? Why? Because in a capitalist system, the one who is more efficient, the one who uses the money more wisely, should be rewarded, is it not? So if the evaluation needs to happen by someone, who that someone will be? That someone cannot just be people who are using the toothpaste. Yes, they are also evaluating your product because they are ultimately the user of the product, but at what efficiency? You can make the best toothpaste out of the world by not being efficient at all. And you can make the worst toothpaste by being super efficient. So there has to be some sort of a evaluation criteria. Why? Because the one who is more efficient must be rewarded. So there are two things, which is rank ordering efficiency and then reward. So when a company floats their stock, people who buy the stock will continuously evaluate the company for its efficiency. And when the stock goes up, then the cost of doing business for that company goes down. We call it weighted average cost of the capital, which is if the net value of your equity of your stock goes considerably high, then the cost of the interest rate that the bank will charge you when you will borrow money from the bank will go down. And because the weighted average cost of capital will go down, the cost of you doing your business will go down. So there is incentive for you to be super efficient on a day-to-day basis. And then that is how the engine generates. So the value these financial companies typically bring on the table is the evaluation, and hence the ultimate decrease in the cost of doing the business for the companies that are super efficient.
Got it. You explained it beautifully, Dada. What's the role then of different financial instruments? What's the benefit of, let's say, shorting and longing the stock? You could keep it simple.
Yeah. The benefit of shorting and longing a stock is the same, which is these are instruments of evaluation of a company. So if I feel the company is doing good versus someone else feels the company is doing bad, because the opinions should not be controlled by a single entity. Everyone should be able to evaluate a company on its own. And so that's why the freedom to go long, which is to buy stock, or to go short, which is to sell the stock. And the market will react based on the sum total of all of these activities.
Yeah, I get that. The only point is then if you know the company is doing bad, sell their stock.
Yeah, but your knowledge may not be same as someone else's knowledge, right? Because just like the opinions in the same room, not five people. If in a room there are 100 people, not everyone will say that a particular political party is doing good. Some will say the conservative is doing good, and the other will say no, conservative are doing really bad. People make their opinion based on certain sub-selection of the data points available to them. No one has complete set of data point, and no one is devoid of the inherent bias. So people should make the decision the way they want to, and hence the opinions will be different, and hence the need for a democratic approach to how the opinions will be honored.
Yeah, but then at that point, I'm still thinking is, it is going to go down. Company is not going to go well, let's say. Then you get out. Why do you have to predict the future? What I'm saying is, without even buying a stock, you are betting in a way, right? So again, I go back to my question of creating value, right?
Yeah, so the
So
value
yeah,
value yeah, so value is exactly in this, which is, let's say the company is not doing good, right? Let's
right.
say it is a common knowledge company is doing bad. There is mismanagement of the firm, and it's bad, right? So almost everyone agrees that a company is doing bad, right? So then everyone will short the stock or will sell the stock, and the stock price will go down, right? Because the stock price is going down, the cost of operation for the company is going up.
Right.
Then the $1 million question is, how much, what is the bear down of the stock? A stock cannot go negative, right? A stock can become zero, theoretically, but it will not become negative, right?
Mm-hmm.
So then people will start to look at, is this the lowest down, or will it go even more? And then there will be few people who will say, now this is it, man. It cannot go any down than this. Because now I can see at this price, the company has been penalized enough. And I can see company taking minor steps to fix itself. Then they will long. So some of them will long.
Yeah.
And
So what I'm hearing then, Dada, is that this is an instrument for investors to make money, not really to punish or really make the firms, in this case, let's say Hindustan Liver, efficient or not efficient. Because you could achieve that just by selling. You don't have to go into the predicting and going there, right? You don't like, you see this. So is it fair to say these instruments are more an instrument to make money for those who are putting money in the stock market?
yes, it is speculation. Yes. But you asked what value does it bring to the market? The value is about evaluating the company, but why should someone spend his life and hour in evaluating people, in evaluating a company? The few professors can do it, right? Harvard professor, Princeton professors, you bring them together, they will publish the rank order every day, right? That can happen. But then if you democratize, then people who are participant to this economy, there must be incentive for them to make money as well. So it
Yeah.
serves the purpose. This is the 101 of the capitalist economy, which is every participant in the capitalist economy must have a solid purpose to be a participant. There must be a good incentive and a solid incentive to continue to do good.
God. And being within the industry, Dada, do you believe, or has some of this been corrected, that there is some incentive to really take risks than really making an informed judgment? What I mean is you take more riskier investments or decisions. In the long term, it pays off, and that's why you do it, rather than a balanced approach. Is there an incentive to doing that?
Yes, absolutely. So in the 50s, there was a mathematician who came up with this formula called as the capital asset pricing model, which is called the CAPM, which simply says that the markets must reward you for the risk you are taking appropriately. Which is the more risk you take, the more reward market should give you, which is how you will be evaluated. So your success or how much money you made will be evaluated on the basis of the risk you have taken, which means if I took a risk of, let's say, 100 unit, I must be rewarded by 140 to take that risk. And if I have not made 140, it means I took a unbalanced risk. I took a foolish risk. So we evaluate how much risk we took and how much money we made because of the risk, and no one takes risk unsubstantiated. It's otherwise, yeah. And if anyone takes risk unsubstantiated, they go down under really fast.
Actually, I agree with what you said, Manish. I mean, yeah, maybe the financial companies, their value is kind of subtle, but of course they do add a lot of value. I kind of agree with that.
No, and also what most people forget is that your 401k, your provident fund, and all of
Exactly.
those
Yeah.
things.
Everyone wants them to do good, but they like to, blame the Wall Street when it does bad. So
Bad.
it's just
Yeah,
human
yeah.
nature.
So yes, because and think about it, most of the infrastructure development happens because there is a fund available to the infrastructure company from the bank. And how does the bank lend you money anyways?
Mm-hmm. Yep.
Anyone
if
else? Any more questions for Manish? This stunned silent, Manish.
I can ask one, Abhishek.
ऐसा ऐसा फंडा मारा है, ये सब जनता स्तब्ध है.
नहीं, एक question
हजम
है.
हो रहा है.
हाँ.
Manish, एक question मेरे से, last question maybe. So what is your advice to like lay investors like me? I mean, we are not like sophisticated institutional investors. Like how important is to like we hear this all the time, diversify your portfolio, diversify this, do this. Like I'm not talking like diversifying just in the stocks and bonds and stuff. Like what other assets can you add to your portfolio to like, with current market scenarios? Like what would be your advice? Like what are upcoming investments that we can look into? What we should be avoiding or to watch out for in like coming years? What are the resources that we can avail, just like lay investors, like like people like me?
Yeah, so So for retail investors, one thing is certain, that you cannot compete with large companies who have access to these massive compute and manpower and resources, right? So the competition is not even. So for retail investor, what's always beneficial is that you do what is called long-term horizon investment, meaning you buy a stock and you don't buy for a week, you buy for months. So if you want to buy for a month, then you're looking as value investment, which is, who do you think brings most value on the table, what company? So if you've been reading the news nowadays, in the US market, there is a bubble of AI, right? Pretty much the same way there was a bubble of e-commerce in 99, 2000, etc. Anyone who said, I have a website now, their stock would go up, right? The same way anyone who said, I started an AI group, their stock is going up. Or even by saying we are going to buy NVIDIA chips and we have placed the order, $100 for NVIDIA chips, their stock will go up, right? So quite clearly there is a bubble of the AI. Did the question arise, do you want to be a participant of that bubble and make some money and get out, or do you hold a contrarian view, which is, this bubble is going to burst, so I'm going to invest somewhere else which is less expensive right now because everyone is buying AI? My answer to this philosophical question is, you do both. So you be a participant of the bubble in the short term and make money till the bubble lasts, and you buy stocks that are really good stocks and really good sectors that are not doing very good because the money is diverting towards the semiconductor companies and the AI worlds. So what we mean is that the AI stocks you will hold for a very short duration of time, few weeks, and the other companies you will hold for longer duration of time. So that's your investment philosophy in terms of holding for long or buying for long in terms of the stocks. And then I would always balance my portfolio by buying some FX because the macroeconomic situation of the US is still very, very fluid. There can be war anytime. The price of the oil may go up. So there is considerable amount of uncertainty. So I would buy some FX to balance my book.
Yep.
Yeah, Dada, one small
Thank you,
question.
Manish.
Yeah, this is Amit. Yeah. So a few days back, I have read a news article which says that 68% of the mutual house company, they failed to even beat the index. So what could have been the reason for this? I mean, they spend all the day analyzing the stock and to understand the business, and even then they couldn't beat the index itself. So what could have been the reason for this?
So I'm assuming you are talking this from a Indian mutual fund perspective, right? The mutual funds in
Yes,
India.
yes, yes, Dada.
So
Yeah.
as far as I know, or based on what I have read, many people are saying that the next largest scam in India is going to come from the mutual fund. And there are multiple reasons for it. Is that A, they are opaque. You don't really know why and how they're operating and why they are buying and what they're buying. So that opaqueness is cause of concern, big concern. Typically, things like this used to happen in the US. You'd have heard people like Madoff and others. So those were huge scam. So that opaqueness is one concern, although on their website or on their communication and the email, they will certainly be sending you the emails, but they are not quite transparent when it comes to the transactions and also the transaction expense. So a mutual fund may invest in the right stocks, but if their underlying expense is very high, the expense ratio, as they call it, they are not going to be able to give you the enough return when it compares to the index itself, which is free. The second part is more philosophical in nature, which is in the long term, it is very hard to beat the index. Very few people are able to beat the index for a long-term horizon. It's not easy. So if the rate of change of index is what we call as beta, so in the US, the S&P, which is the S&P 500 index, is called as beta of 1. Anything we make in excess of beta equal to 1, which is more than the S&P, is called alpha. So in our industry, generating alpha is how we are able to charge the clients money. We charge the clients money on the alpha, not on the entire return itself. So, but it is a hard game. It is not easy, and mutual funds are not incentivized to make money in excess of the free return, which is the Nifty. There's no, that structure in India is not there yet. So if you ask a mutual fund that you should charge me, or you should take your expense only on the excess return you return from Nifty, then you will not have a successful conversation with them.
Okay, yeah, that answers. Yeah, thanks.
Okay, friends, we've got 5 to 10 minutes. So any more questions, any light-hearted comments? Doesn't have to be some serious philosophical stuff. You can simply ask Manish about his World Cup cricket experience, if he's going to any matches, his predictions on World Cup. Anybody wants to put sattas on it? All this. But we've got 5 to 10 minutes maximum. I have been informed by our host that we need to wrap up soon.
Yeah, Manish is my neighbor, basically, not too far away. But मनीष दा चाय पे कभी चर्चा करते हैं, क्रिकेट वर्ल्ड कप पे चलते हैं, हाँ कल गेम है, गेम देखने चलते हैं, हाँ I heard the stadiums are terrible though, huh? I heard the stadiums are terrible.
I mean, 10
Yeah,
of my
but like I tried to book the tickets, like almost like I know 40 people who tried, किसी को नहीं मिला वो इंडिया पाकिस्तान का टिकट. एक लॉटरी हुआ था, लॉटरी में किसी को नहीं मिला.
No, but
लेकिन अब
Prasanji,
काफी लोग बेच रहे हैं, अब काफी लोग बेच रहे हैं, काफी लोग बेच रहे हैं, लेकिन अब आप देखिएगा तो क्या होगा.
1 घंटा पहले लॉस्ट में बेचेगा, तब हम खरीद लेंगे और चले जाएंगे.
Manish,
देखिए
10 of my friends from here have flown on Saturday. I mean, this morning, $500 का टिकट मिला, 10 लोग गए यहाँ से.
हाँ, अभी मेरा नेबर है, उसने 2 दिन पहले फोन किया था, टिकट चाहिए, मैं 1000 में बेच रहा हूँ. मैंने बोला गेम शुरू होने के 2 घंटे पहले तेरे को मैं फोन करूंगा, तू ये मुझे $50 में देगा, एंड आई नो इट. तो वो हंस रहा था.
दादा मेरे लिए भी एक ले लीजिएगा.
हाँ, ले लीजिए.
कितना दूर है तुम्हारा घर से मनीष एंड रितेश स्टेडियम?
दूर है.
आधे घंटे पे
45
minutes. 45 minutes. हाँ
45 minutes.
ओह, कुछ भी नहीं है.
45 minutes. दादा टिकट खोज के रखिए, आपको ड्राइव करके ले चलता हूँ मैं.
ठीक है.
45 minutes है तो ड्राइव के लिए भी जा सकते हो ना, बाहर घूम के आ जाओ, माहौल लेके.
इंडिया पाकिस्तान
इंद्रनील वही करता है, बाहर से स्टेडियम में घूम के आता है, फोटो खिंचा के भेज देता है, हम मैच में गए थे.
माहौल ही है बस, और कुछ नहीं. लेकिन स्टेडियम की थोड़ी हालत खराब है. पीपल वर सेइंग कि इवन द restrooms and all these are makeshift in a not a great shape. थोड़ा सा ये है, लेकिन who cares? इंडिया पाकिस्तान है, I get it.
Sure, enjoy guys, enjoy.
नहीं, all good. दादा आपने शुरू में हो सकता है बताया होगा, but आपके क्या, मतलब I joined 20 minutes late. Prediction of the US economy. There is a lot of uncertainty and kind of hitting a lot of industry. So any high level thoughts in the short term, in the next 6 months?
Yeah, a lot depends on the election. So yeah, so that's why you will see that the net investment in the market, the speed of the transaction has lowered down because people are keeping money on the sidelines and they're looking at what's going to happen. A lot depends on the interest rates, whether they will decrease or not. Earlier, there was a expectation that in the July the rate will go down, but now it seems that's not going to happen.
I thought they did something for you.
Yeah, somebody go on mute. Sorry. Yeah.
My 400.5. So I feel we do not have any more questions. So before we wrap up the session, I'd like to thank Manish Da, Abhishek Da, and the whole 1993 batch for this amazing session. Because without their support, we could not make it happen. And I also like to inform you all that this session will also be available on YouTube. We will be uploading it in some time, and so you all can watch again. So with that, I announce this meeting as closed. I will stop the recording and you all can chit chat for a few more minutes.